The list of assets is fundamentally heterogeneous. We have learned how to construct the income statement and the balance sheet of a firm for each cycle. These documents are very powerful to have at a glance a view of how the firm is performing. Now it is time to see some of their limitations. The list of assets, in this balance sheet we have assets and liabilities. The list of assets is fundamentally heterogeneous. That's what we are going to explain in this lesson. These assets should be seen more just as a list than a presentation of the worth, the true worth of the firm. Let us distinguish three categories in the assets. In the past, we have considered two categories, fixed assets and current assets. But let's split the current assets into two parts. So the three categories we shall talk about today are, first of all, the cash and bank and the short-term financial assets and the clients, first category. Second category, the stocks. And third category, all the fixed assets. And let us comment on each of these three categories separately. Remember that all the assets are recorded in the balance sheet at their acquisition cost. For the cash and bank, that is cash and money at the bank, their acquisition cost is of course their market price today, because a banknote of 100 euros received in the past is worth 100 euros today. The same is true of short-term financial assets, since, as we saw in the past lesson, it is very liquid without a loss on its value. And for the client paper, their recorded value is almost their market value, at least for good clients. Because good client paper can be sold with a small discount to somebody else, and this small discount is a consequence of the delay of payment of the client and the risk of the client. Second category, the stocks are recorded at their acquisition value, that is at their wholesale value, not their end market price. Let's consider we are talking about a retail shop as usual. The fundamental profit generation of the shop is to buy at one price and to sell at a higher price. We saw that many times. So the profit generation is the difference between the end market price of stocks and their acquisition cost for us. It covers the charges to operate the shop and the profit of the owners. Third category, the fixed assets. They are also recorded at their acquisition cost. Usually, we don't intend to sell these fixed assets. The operations of buying and selling are for stocks. But what is sure is that their market price today is, in most cases, not their value recorded in the balance sheet. And this is particularly true of land. The profit generation for a firm is through sales, normal sales of the stock items, and sometimes exceptional sales of some of the fixed assets. And there is a fundamental rule in accounting: the profit is only recorded at the time of the sale, not before. Let's frame that rule in red. This is a principle that was set up at the beginning of accounting 8 centuries ago. The profit is only recorded at the time of the sale, not before. However, if there is a big potential loss in some of the assets, then it's an exception. According to the prudence rule in accounting, we want to record it, this loss, via an adjustment during the cycle when it is observed. It's a provision of one sort of or another. The case of long-term financial assets is a bit special. Suppose that we keep a portfolio of long-term financial assets with the intention of making financial operations, buying and selling. And that is, of course, true particularly of banks and various financial outfits. In that case, the generally accepted accounting principles, there are some guidelines, this is the American name, they have defined ways to mark-to-market the financial assets. In that case, we shall not keep them recorded at the acquisition value. But this idea, getting away from the principles of accounting set up 8 centuries ago, doesn't work very well. Market prices change all the time, and this idea creates lots of accounting work, first of all. Secondly, market prices, I haven't specified it here, are not always easy to figure out. And thirdly, this idea has been viewed recently as one of the causes of the subprime crisis. Let's say one word about the subprime crisis. The subprime crisis was simply created by American banks which sold loans to uncreditworthy people, but their house looked like a good guarantee. And when I say that they sold loans, that is, they gave money and they received promises of payment back. Then these loans were securitized, packaged, and resold all over the world to all sorts of banks. And then the mark-to-market procedure precipitated some banks' bankruptcy when the financial assets, however, could have regained value. That is, the idea of, in the assets, to mark-to-market the financial assets, and therefore to decrease them because of the subprime crisis, accelerated the subprime crisis. To summarize this lesson, remember that assets are heterogeneous, and they are more a list than some sort of a fundamental true representation of the worth of the firm. Some are naturally at their market value, cash and good clients. Stocks are naturally not at their end market value, and the fixed assets are usually not. And the idea of trying to change their value recorded according to the mark-to-market new idea doesn't work very well.